Let me introduce my first guest for the day. We've got Feroze Azeez, who's the Deputy CEO at Anand Rathi Private Wealth Management. Thank you so much, Feroze, as always, for taking the time. And I think one of the biggest issues that a lot of senior citizens face is that when they look at their portfolio, they're not really sure about the construction. And of course, we talk about portfolios or we're talking about asset allocation strategies per goal, right? So if you have a retirement goal, then it has to have a certain allocation strategy. But overall, more often than not, they're struggling with which product to buy, how much equity should I have, how much fixed income should I have, am I taking care of my immediate requirements? So is there a broad construction where you can say that these elements absolutely have to be there in my portfolio?
Alex. Definitely, there are some which are intersecting elements across different portfolios, cuts through different strata, different age groups post-retirement. There's some which are practically compulsory instruments to have, to my mind. That's one. Two is, of course, when a person retires and if he has a retirement corpus, now he has entered or she has entered into the zone of consumption of that corpus which has been accumulated over decades. So when they've gone to consumption, the first most important question which comes to mind is how long will they need this money for? That's consumption. Of a period of 10 years, 15 years, 20 years, that's where life expectancy of Indian male and women comes into picture. That's the second element. The third, coming back to your question of what are mandatory instruments, to my mind, is a debt mutual fund becomes a practical mandatory instrument because that's the most tax efficient way of parking retiral consumption driven money, because a systematic withdrawal plan gives you tax efficiency other than a fixed deposit. So debt mutual funds have to form a part of a retired portfolio. Of course, equity in a certain component of the goal in a smaller proportion also becomes a mandatory instrument because of inflation and life expectancies, which we saw. If you're at the age of 60, there's a 97% chance that an Indian male non-smoker lives till 70. That's 97% chance. That means you have a 10-year period for some portion of your money, and the probability that you will outlive 70 years is 97%. If you're a smoker with less than 15 cigarettes a day, then you have a probability of close to 91, 92. Those are very large probabilities. That means a person who retires at 60 minimum has 10 more years. So having 10-year investing with zero equity is not a practical thing, especially in a high inflationary environment which we currently live in.
I must point out that just because you have a higher probability, despite the fact that you're smoking, that doesn't mean that you should, and you should actually quit if you are. But that's, I think, besides the point, right, Feroze? Let's talk about finance, right? And let's talk about the most important objective, I would think, for a lot of people that have crossed that benchmark of 60 or that threshold of 60 is to ensure that they have money coming in on a regular basis. That is, I think, the worry that a lot of them have, and to ensure that that sustains throughout their retired life, which, as you pointed out, is going to be 30, 35 years. So how do they ensure that that takes place?
Yes, so I think anybody who's retiring or almost retired now, I think it's a great time to retire. One, because you're speaking of a higher interest rate environment. We've gone through several cycles, the 90s where interest rates were 12, 13%, even on a government bond. Then we went to the 2010s, 2006 to 2010 period where 6%, 5%, even 4.5% was seen on Government of India 10-year paper. Now, again, we are in a phase of 7.5% government paper return on a 10-year basis. So this is a good time to retire because you're going to have recurring income having to be provisioned for in your bank account. So point one I'm trying to make is that you having tax efficiency and having a debt fund which only lends to Government of India for your 5-year kind of consumption objective. So what I would do if I was retiring is break my component of money into two portions, less than 5 years, greater than 5 years. The strategy for less than 5 years is going to be crystal clear. Consumption, and greater than 5 years is going to be inflation beating returns. So you have two buckets for the same person with different mindsets, different objectives. So the first objective of recurring income is fulfilled buy that 5-year, less than 5-year bucket. In that, you can buy a GSEC index fund, for example, an IDFC GSEC index fund. Just for illustrative purposes, I'm getting into a fund which can give you a post-tax return of 6.5% credited to you on a monthly basis for the subsequent 5 years. And that, I think, can give you, almost a 9-10% fixed deposit impact on a pre-tax basis. So that's where you fulfill your consumption need, and the strategy for 5-year plus monies will have some degree of equity and some degree of risk, which will get mitigated because of the tenure of investment itself.
Oh, Feroze, the challenge, as I mentioned at the start of the show, is that when we're talking about personal finance, we talk about these common issues. We're talking about, will I have enough money for the rest of my life after retirement? We're talking about, I need a certain amount for a house. While those issues are common, the context is always different. So I thought, let me come up with a few scenarios. I shared them with you. And let's talk about these as models, of course. And of course, people should consult with an advisor to fine tune this, but I thought that maybe this can help a little bit. So the first scenario that I picked was that an individual has accumulated 2 crore rupees of a corpus over the course of their career. They're retiring today. They're living in their own house, so therefore they're not spending on rent, but maintenance, of course, is going to be there. Their per month expenses accounting for all of that is around 50,000 rupees, which is actually a reasonable amount. Some people might spend more, and we'll come to that in a different scenario. But this individual that I'm talking about is a little risk averse, but is willing to take equity exposure. What, according to you, should the strategy be here?
See, if somebody's got a 2 crore corpus and a 50,000 rupee expense, you're speaking of a 6 lakh rupee expense per annum. 6 lakh rupees on a 2 crore base is just 3% expense of the total corpus. If you have 2 crores and if you want to spend 6 lakhs, 6 lakhs as a percentage of 2 crores is just 3%. It's a beautiful retirement goal having been achieved, point one. If you break it down into 3 components, less than 1 year, I would say 100% of that will be in debt. If you're speaking of the current context, even anything greater than 2 years, 6 years, I would say 40% should go into equity, in spite of not having any income currently. And anything greater than 6 years should have 60% in equity. If you look at these 3 buckets being 1/3 each, or 20% in the first bucket and 40% for the subsequent 2 buckets, 2 to 6 years and 6 years plus, you will have an overall equity which will be 30-35%. That will be my recommendation from a person for a person who's retired with 2 crores with a 50,000 rupee expense. 100% debt portfolio for the first 2 years. Money is important.
Fantastic. The second scenario is a slightly different scenario, where you're talking about somebody who has accumulated 1 crore. And I think a lot of people, and we've spoken about this, incidentally, Feroze, the last time we spoke about how you can accumulate 1 crore in a period of 10 years, and you spelled that out very nicely. Assume that that person has been able to do this. Their per month expense is about 30,000 rupees per month, and this individual has 0 equity investments as things stand right now, and is also averse to making these investments. There are a lot of people like that out there, Feroze. What should these people do?
See, to my mind, if somebody has got a crore of a corpus and he or she is averse of having any money in equity, then that itself is a risk. Because you're speaking of real returns being negative. What is a real return? Of course, for the benefit of viewers, if your inflation number, which latest is 7.04, and if your FD is at 7, for example, and you're paying tax and getting to 6.3%, 4.3%, you're making a negative real return. So you're sure to have a very bad last phase of your life. So accepting equity, what proportions, 10, 20%, being in equity is important. Let me give some data to give the courage. It's easier said than done. Somebody who's not participated in equity and accumulated a crore, that's great job done, but it's not easy for a person to take a plunge at the age of 60, 62 into an asset class which he or she is not familiar with. Let me give some data to give that courage. If we analyze the last 27 years of private sector mutual funds on the equity category, there were about 11 funds in 1993. The worst return for a 10-year investor has been 11.4%. That means the most unlucky 10-year investor in the funds which were there for the last 27 years is 11%. So the risk is academic if you have the courage to close your eyes to it. If you're putting 10% of your money, 20% of your money in equity, even if that turns zero, the debt will be a shock absorbent to the rest of the equity exposure, because 80% will still be in debt, which can grow back to 100. So point I'm trying to make is, please accept equity, because the risk of inflation, which is not visible to naked eye, is a very, very scary inflation risk. So in 1979, if you could buy something with 5 rupees, today you need 100 rupees to buy the same commodity. So money is depleting in its power. You have to hedge against it. Don't just look at the risk which is visible to naked eye, but also the termite as it is, inflation, which is a risk which makes your money lose its sheen, should be protected against, and love the asset equity, at least to the extent of 10-20% of your money.
The third scenario I would think is a blue sky scenario, right? If we thought that 2 crore was comfortable, then somebody who's got a 5 crore corpus, living in their own house and per month expenses of even 75,000 rupees seems like a bit of a breeze, right? And this individual, what I've said is, they've got 50% of their total corpus, which is approximately 2.5 crore, invested in equity. The rest they have kept in highly liquid instruments. So they got a substantial amount of money in their savings bank account, and they're drawing as and when they need it. Is that a bad strategy? Should you allocate better to fixed income?
Yes, Alex, it's a bad strategy. It's a lethargic strategy. It's a no-brainer strategy. So application of mind creates value. So leaving money in savings account is like expressing your love for the bank in the form of cutting a gift check to them practically. So today, if Government of India bond of a 5-year paper is quoting at 7.2%, in a debt fund wrapped as a tax efficient platform, can give you 6.3, 6.4% post-tax, which is as much as 3 times more than savings account. If you have left 2.5 crores in your savings account, it can behave like 7.5 crores from a return standpoint if you went into a debt fund, which does not, the fund manager does not play around and trade in it, but buys a government bond, holds it as an index for 5 years. There, if you do a systematic withdrawal plan, your tax liabilities could come down to 1/7 or 1/8 of the tax liability. So please don't underutilize your money, especially when your incomes from profession have come down to zero or nothing. It's important that your money works more efficiently. So I would never suggest leaving money in a savings account at 4%, 4.5% taxable. And there is also a lot of fine prints which bank have, which is the interest is calculated in several banks on average daily balance, or sometimes on minimum balance during the month. So point is, you're so right, Alex. It's underutility of money, and you can't afford it unless you were getting salaries. At that point in time, inefficiencies were okay to live with.
Absolutely. I want to come to the next point, but very quickly, this is obviously a challenge, and I think you spelled it out very beautifully in scenario 2, where the individual is completely risk averse, does not want to put money into equity, but you said that it's absolutely essential. Would a passive approach, an index approach, looking at a Nifty 50 fund be appropriate here? Of course, I don't want you to make a broad suggestion, but if somebody is uncomfortable with the number of options, you mentioned there were only a few options to begin with, but now there's a multitude of options to choose from. Is simplicity the best option here?
Yes, Alex, if you get into even an index fund like a Sensex or Nifty, out of the 3.5 lakh crore in passive funds, which India has today, 82% of that is between these two indices. So point is, yes, 90% of the job is done if you got into the equity. Of course, then first, every time you get to your doctorate or a PhD, you go through different classrooms and graduate. So at least taking the plunge with a simplistic Nifty or Sensex is a great start, and 80-90% of the job is done just by the asset allocation without pursuing the fund management skill. I completely concur with you, Alex. But now that we are on scenarios, I want to add one small scenario. Because all the 3 scenarios which we discussed had reasonable amount of corpus liquid at the time of retirement, and also had a home to live in. But like globally, there's a concept where you have something called reverse mortgage. is a very beautiful concept. Let's assume I am living in my home, but I don't have the money at retirement, which could also be the case with several Indians. At that point in time, taking a loan, which is called almost a reverse mortgage on the home, spending that home money during your lifetime is also a great idea. That's how global retirements are planned. Just to create curiosity amongst viewers, that's called reverse mortgage. People live in that house till their demise and use the loan up, because the next generation can take care of themselves. And as long as an individual, I'm able to take care of my retirement, even if I don't have a large corpus and a home to live in, a loan against that can help you live the next 10, 15, 20 years more satisfactorily if you have not been able to plan much in advance for your retirement.
Because incidentally, we just discussed this on the program on Friday, I believe, and we spoke about the fact that even the people that come after you, your inheritors, can actually go back to the bank and clear the dues and in fact take possession of the house at that stage. Or if there is a difference between the market value of the house and the loan that was taken, then that difference is paid to the inheritors, so to speak. I do want to ask about convenience and what people are most familiar with, because I think, Feroze, a lot of people that have reached the age of 60 right now are very comfortable with fixed deposits. That's the easiest, that's the most, they don't need to worry about things. They've been talking about it so long, but it's not tax efficient. Is convenience more important than tax efficient returns?
I think convenience is not important at all, right? Quite a few times, certain investments give you the convenience, and sometimes they are simple, very, very simple, and like an FD, you get it for different time frames. So you may want to not apply your mind and go ahead with an FD. If you look at an example of 1 crore of rupees, if you're getting the same rate of an FD, or even the current rate of 5.76%, which you get for senior citizens, almost 6% is what gets offered in an FD. If you look at the kind of tax you end up paying, you will make about, in a period, if you made about 18 lakh rupees maturity value in a 3-year period, your tax is going to be 5,64,000, and you will be left with only 12,44,000 as your gain, which is a pre-tax return of 5.7, for example, and post-tax return of 3.99%. 4% post-tax return is underperforming inflation by 3%, which is depleting your value. Now, if you say, let me apply little mind, let me not get into equity, let me apply little mind, go into a debt mutual fund, like for illustrative purposes, we have used IDFC Guild Fund Index 2027, has a after expense locked in yield of 7%. You pay only a tax of 2 lakh rupees on your 22 lakh rupee gain, and you're left with a 6.39% post-tax return, which is significantly more than a 3.99. So marginal mind application is what I will humbly submit each viewer, especially the retired ones, to apply and not get too intimidated by getting into a debt fund, especially when in effect you're lending to the government of India, which is the safest instrument, and it's an index fund, so very low expense and a great tax efficient instrument.
Well put. In fact, you might take higher risk if you put money in a small bank with the hope of getting a higher interest rather than giving money to the government, as you said it. I do want to deal with one last element, which is something that is of immense value, I think, to a lot of people beyond the age of 60, which is health and health insurance. We talked about contingency funds just yesterday. We talked about a health fund. But in certain situations, Feroze, people get a little afraid looking at the kind of premium that they have to pay. Is a health insurance policy the easiest and best option, even if it is a little expensive?
See, health insurance is very critical, especially in India, because Indian medical inflation is lagging behind almost 30 years from the globe. Today in MD Anderson, which is one of the Texas hospital, which I done some research on for cancer, chemotherapy has 8 crores as an Indian rupee as an expense. In India, the same equivalent hospital charges about 14 lakh rupees. So India has not had a very large medical inflation over the last few decades. it is now catching up because of the government policies of ensuring the lower strata. Inflation on medical is going to be very, very big concern over the next 10, 15, 20 years. So that's point one I'm making. Point two, that's why you see premiums being a little exaggerated. So always spend that money because it can put your entire post-retirement corpuses at stake. And that is one space where you would never be wanting to compromise. You would want the best hospital, best doctor, best medical equipment being used. So you can't even compromise there. So it's going to be a catch-22 situation. That's point two. Point three, I'll give you some little minute tricks which can help you sail through this better. If you're a couple, elderly couple, take a floating cover between the two of you. The probability of both of them going through adversity in the same financial year is lower. So your summation of premiums is going to be lower if you take joint policies. Always take top-ups. The first 10 lakhs is going to be very expensive. The subsequent 10 lakhs is going to be 1/4 the cost. So never settle at 10 lakhs, take 20 lakh cover because the next 10 lakhs is going to be 1/4 the cost of the first 10 lakhs. Then one more trick, which I'll tell you, which is not a trick, but it's a good thing. If your child is employed with an employer, take a group insurance which covers the parent. Like at Anand Rathi, we allow our employees to take insurance for their parents. Since it's a group insurance, all of them get the benefit and the premiums become 1/3 of what an independent person can buy. In my parents' case, my parents were not coverable at all. But since it is through the group policy, they're covered and they've been able to enjoy the benefit of that over the last decade.
That covers this very nicely, because these are all issues, Feroze, that people have mentioned that are major concerns, and I think we've addressed each one of them. Thank you so much for taking the time, and really a pleasure speaking with you.
Thank you, Alex. Have a nice day.